38,000 jobs are gone in Detroit.
This isn't just a headline, it's a warning bell. It's not a number, it's the sound of entire neighborhoods falling silent, of lunchboxes gathering dust, of schools cutting teachers, of homes quietly slipping into foreclosure. And while this economic silence blankets Detroit, something very different is happening just north of the border. In Ontario and Quebec, international investors are pouring billions into new industrial projects, battery plants, logistics hubs, manufacturing corridors tied to Europe and Asia. While one engine stalls, another roars to life. Detroit is the old engine. It sputters and shakes with every policy speech, every promise of a manufacturing revival that never comes. Canada? Canada is the engine running on clean fuel, stable trade deals, cheaper energy, and the quiet confidence of strategic partnerships. So here's the real question. If jobs are disappearing here, why is the money rushing there? Why are factories, billion-dollar contracts, and new technologies heading across the border, while American workers get pink slips? And more urgently, how can you, the everyday citizen, the concerned investor, the retired worker with a shrinking pension, protect your wealth from this shift? Even better, is there a way to actually profit from it? Because whether Washington admits it or not, the North American industrial map is being redrawn, and those who see it early might not just survive, they might win. In boardrooms and newsrooms, they call it a market correction, a necessary adjustment, a line on a quarterly report. But on the ground in Detroit, 38,000 job cuts mean something else entirely. They mean empty parking lots at once thriving factories. They mean fast food restaurants that can't survive without the lunch rush from nearby plants. They mean teachers laid off because tax revenue disappeared with the jobs. They mean bankruptcy, not just for families, but for entire communities. And yet, where is the outrage? Where are the headlines with urgency? This isn't the first time Detroit has been left behind. Flint in the 1980s serves as a chilling reminder. Back then, factory closures were also framed as temporary. The rhetoric was filled with restructuring, revitalization, and return. But the factories didn't return. The jobs didn't return. What returned was crime, abandonment, and despair. That's the real pattern here. One factory closes, its suppliers follow, tax revenue shrinks, public services collapse, property values fall, families move out, silence sets in. The media can spin it all they want, but for the people who live it, there's no spin, just the sound of an economy dying in slow motion. The most painful part? The silence. Not just the silence of machines that once roared, but the silence of politicians who promised to fight for American jobs and now look the other way. Donald Trump promised to bring the jobs back. He promised tariffs would protect American workers, that punishing China and renegotiating NAFTA would make Detroit thrive again. He stood at podiums and declared economic war, not just against foreign competitors, but against the very trade architecture that kept North America interlinked. But instead of a revival, we got a rupture. Trump's tariffs triggered retaliation, uncertainty, and a domino effect that made doing business in the U.S. riskier and more expensive. While he slammed doors shut with his America First rhetoric, Canada quietly opened new ones to Europe, to Asia, and to global investors seeking stability. Here's what the mainstream media won't say. Under the rules of origin embedded in new trade agreements, Canadian-made goods, especially autos and industrial components, still qualify as North American. In other words, a company can shift operations to Ontario, benefit from cheaper energy, generous tax breaks, and global access, and still sell to the U.S. as if the product were made in Michigan. It's legal, it's strategic, and it's killing American manufacturing cities. While Detroit loses factories, Ontario gains industrial clusters. While American towns bleed tax revenue, Quebec signs new deals for clean energy infrastructure. The numbers don't lie. Foreign direct investment in Canadian manufacturing has surged. Plants for electric vehicle batteries, hydrogen, and high-tech exports are being built, not in Ohio or Michigan, but just across the border. This isn't just a trade imbalance, it's a transfer of industrial power. And it was triggered ironically by a president who claimed to be saving American industry. Washington loves to talk tough. Every election cycle, we hear the same promises. Bring back the jobs. Rebuild American industry. Make it here, not over there. But behind the podiums and press releases, the reality is harsher. While U.S. politicians chant slogans about industrial independence, the private capital, the real decision maker, is moving in the opposite direction. Why? Because slogans don't pay the bills. Incentives do. Canada, unlike Washington, isn't relying on nostalgia. It's building an industrial future with precise, targeted incentives and international credibility, subsidies for battery production, energy prices that undercut U.S. regions, trade agreements that don't alienate global partners but invite them. The United States, under Trump and his successors, chose confrontation over cooperation, and in doing so, it isolated itself. While Trump imposed tariffs, Canada signed a massive trade pact with the European Union, the Comprehensive Economic and Trade Agreement, CETA. While the U.S. waged a tariff war with China, Canada negotiated access to Asian markets through the CPTPP. It's like watching two teams play different games. America is on a field alone, kicking a square ball uphill, shouting about fair play. Canada, it's playing a coordinated match with international support, a cheering crowd, and a strategy. Investors know which game is worth betting on. The reshoring myth, the idea that companies are flooding back to the U.S., sounds powerful in speeches, but it collapses when you follow the money. The truth is, capital goes where it feels safe, welcomed, and profitable. Right now, that's not Detroit, it's not Cleveland, it's Toronto, it's Montreal, it's Windsor. In the end, capital doesn't care about patriotism. It follows the path of least resistance and most opportunity. This is not just about trade policy. It's about the slow death of cities that once powered America, about families losing the only asset they had left, their homes, about retirement plans quietly dissolving without a single headline. In towns built around a single industry, collapse doesn't need a crisis. It begins when one factory shuts down, then suppliers close, tax revenue evaporates, schools and hospitals face cuts, home values drop, and what remains is economic silence. This isn't theoretical, it's happening, and it's spreading. When property values fall in industrial towns, it's not a fluctuation. It's capital signaling it has lost confidence in the future of that region. Not just capital, but families, investors, and institutions choosing to walk away. Meanwhile, across the border, the story is different. Ontario and Quebec are not just receiving money, they are building entire industrial corridors, not because of ideology, but because they offer what investors crave: energy stability, global trade access, political consistency. These aren't flashy headlines, they are structural advantages, and the capital is following. Exchange-traded funds tied to Canadian clean energy, advanced manufacturing, and logistics are quietly gaining strength. International firms are anchoring themselves in trade zones that connect to both Europe and Asia. These are not speculative bets. They are the foundation of a new industrial map, one that no longer centers on Detroit or Pittsburgh. Every global shift draws a line between those who act too late and those who recognize the turn early enough to reposition. In the 1980s, some saw the writing on the wall with Japan's rise. While leaders in Washington raged about unfair trade, others moved their investments and built lasting wealth. Today, the pattern repeats. But the capital flight is heading to Canada, not across the Pacific. And while American politics remains stuck in slogans, the next era of industrial leadership is already under construction, just not where most people are looking. History doesn't repeat itself, but it often rhymes. In the 1980s, the United States watched as its dominance in electronics and manufacturing quietly slipped away. Japan, once dismissed as a junior partner in global trade, surged ahead with government-backed innovation, aggressive export strategies, and industrial coordination the U.S. refused to match. The result? Entire sectors, from semiconductors to consumer electronics, moved east. American cities that once thrived on tech and manufacturing became shadows of themselves. Washington responded with tariffs, complaints, and speeches, but capital had already moved on. And for a generation, the U.S. paid the price. Today, the pattern is eerily familiar, but this time the shift isn't to Tokyo or Seoul, it's to Toronto, to Montreal, to Windsor. Once again, the U.S. is trying to revive lost jobs using tools that no longer work. Tariffs instead of incentives, rhetoric instead of strategy, political theater instead of economic planning. Trying to rebuild a 21st century economy with 1980s tools is like planting corn on asphalt. It looks like effort, but it yields nothing. Meanwhile, Canada is replicating what Japan once did, with cleaner energy, global access, and a clear industrial vision. And, once again, capital is voting with its feet. There's a lesson hidden in this historical echo. In the 1980s, those who understood the shift early and invested in Japan, in its companies, in its tech, in its export, weren't just insulated from the fallout. They profited from it. Today, the same pattern is unfolding. The geography is different, but the choice remains the same. Look backward and hope things return. Or look forward and adapt before the landscape changes permanently. The contrast is no longer theoretical, it's unfolding in real time. Detroit is shutting down factory lines, while Ontario lights up new industrial corridors. Michigan loses tax revenue, while Quebec signs billion-dollar contracts. The U.S. government clings to tariffs and slogans, while Canada builds ecosystems of innovation anchored in global trade networks. This isn't just a policy failure, it's a strategic collapse. The U.S. focused on punishment, tariffs, threats, isolation. Canada focused on attraction, incentives, partnerships, stability. One model burns bridges, the other builds them. And while Washington debates, neighborhoods vanish. The human toll is immense. Families who believed in the promises of American revival now watch their cities decline, their homes devalue, and their children leave in search of better futures. But amidst this erosion, a new map is forming. A North American industrial backbone is emerging, one that runs not through Rust Belt America, but through Canada's clean energy corridors, export hubs, and critical input supply chains. This is where the next phase of manufacturing will thrive. This is where capital is flowing, quietly, consistently. And for those paying attention, it presents not just a threat, but an opportunity. The ones who recognize the shift early can protect their assets by reallocating into sectors that are expanding under this new order. Clean energy, advanced logistics, battery technology, and supply chain infrastructure in Canada are no longer side stories. They are the main stage. This isn't about abandoning the U.S. It's about acknowledging where momentum is building and positioning accordingly. Because while Detroit shuts off the factory lights, Canada is powering up the turbines of the future. And those who align with the new current, instead of resisting it, may not only survive this transition, but come out wealthier, stronger, and far ahead of the curve. Not every moment in history is an opportunity to take big risks. Sometimes survival itself is the strategy. And in times like these, with factories closing, trade routes shifting, and policies swinging wildly, protecting what you already have becomes far more valuable than chasing what you might gain. Avoid overexposure to volatile markets. When industries shift across borders, capital often moves suddenly and without warning. Those who remain tied to vulnerable sectors risk losing decades of savings in a matter of months. The collapse of U.S. manufacturing towns shows exactly how this unfolds. Entire communities once promised revival were instead abandoned. That is why it is dangerous to rely on political promises of industrial rebirth that never materialize. Stay liquid and conservative. In uncertain cycles, liquidity is power. Short-term U.S. Treasury bills, T-bills, remain among the safest ways to preserve capital. They are backed by the U.S. government, provide predictable returns, and can be rolled over as economic conditions evolve. This approach is not about chasing high gains. It is about stability, flexibility, and survival when markets turn volatile. Hedge against systemic risk with gold. For centuries, during periods of industrial transition and political upheaval, gold has served as a reliable store of value. Unlike currencies or stocks, it does not depend on trade agreements, elections, or corporate strategies. It is a safeguard against systemic shocks. Holding part of your wealth in gold is not about speculation. It is about ensuring that when systems fail, you still hold something universally trusted. Reduce debt exposure. In times of economic contraction, debt quickly becomes a burden. Rising interest rates, shrinking job opportunities, and falling property values can turn manageable obligations into crises. The safest position is to avoid taking on new liabilities and to pay down existing ones wherever possible. A strong balance sheet provides resilience when external conditions deteriorate. Focus on preservation, not growth. This is not the time for risky stock bets or speculative ventures. It is the time to think like those who endured past crises, families who protected their wealth, kept their expenses lean, and waited out the storm while others collapsed. Preserving what you have now ensures that when recovery comes, you will still have the foundation to grow again. Protect your home, protect your savings, maintain flexibility. The truth is clear. Industrial maps can be redrawn overnight. Politicians will adjust their rhetoric as quickly as the winds shift. Corporations will chase incentives wherever they appear. But your financial stability depends on resisting those swings and focusing on what endures. The opportunity in this moment is not in reckless ambition. It is in preserving wealth while others lose it. In times like these, caution is not weakness. It is strength. History proves the point. Those who stayed steady during the turbulence of past industrial shifts were the ones who survived intact. And when stability returned, they were best positioned to rebuild, grow, and prosper, not from luck, but from the discipline of protecting what mattered most. If this content helped you see the bigger picture, like the video and subscribe. This channel is just starting, and your support makes a difference.